The billionaire glitch. How to opt out of the income tax system. The $0 mystery. In 2007, Jeff Bezos, the man who built the largest store in human history out of a garage and a borrowed idea, paid exactly $0 in federal income tax. Not a reduced rate, not a loophole that saved him a few thousand. Zero. Zip. The same number your broke college roommate paid. In 2008, Elon Musk, same result. Carl Icahn, 3 years in a row. When most people hear that, something tightens in the chest. The jaw sets because you just got your paycheck and watched 30% disappear before you even touched it. You didn't get a choice. There was no box to tick, no strategy to deploy. It was just gone. Taken cleanly and automatically before the money ever felt like yours. So what do these men know that you don't? The first instinct is crime, offshore shells, secret accounts in the Cayman Islands, a team of lawyers doing something technically illegal but practically invisible. That is the working class model talking, and I don't mean that as an insult. It is the only model most of us were ever shown. Work, earn, get taxed, spend what is left, repeat until you are 67 and too tired to care. But Bezos wasn't breaking any laws, neither was Musk, neither was Icahn. They were using a strategy that has been sitting inside the American tax code since 1921, written in plain language, completely legal, available in theory to anyone. Your accountant has probably never mentioned it, not because they are incompetent, because it only makes sense once you have built a very specific amount of momentum, and most of their clients haven't. Today, we crack it open. It is called buy, borrow, die. The mechanism that keeps 8-figure net worths invisible to the tax system for entire lifetimes. By the end of this video, you won't just understand how it works, you will know the exact threshold where it starts working for you. The linear trap, why you are losing the race. Picture a conveyor belt. You step on at 22. You work. Money comes in one end. Taxes take their cut immediately, before you see it, before you decide anything, before you have any say. And what comes out the other end is yours to spend, save, and stress about. This is the model, the one school taught you, the one your parents modeled, the one the tax system designed and polished and would very much like you to keep using forever. Meet Sarah. She's sharp, disciplined, doing everything right. She wanted to build a $5 million nest egg, not to be extravagant, just to know her family was secure, that a medical bill or a market dip wouldn't undo decades of work. So she earned. She got the bonuses, she took the promotions, and every single time money arrived, the government took 30% off the top. Then, when the market performed and she needed to sell some winning stock to pay her daughter's tuition, capital gains tax came for another 20%. Her compounding engine was running, but someone had attached a bucket to the exhaust pipe, and a third of everything she generated was draining straight into it before it could compound. The truly wealthy looked at this conveyor belt a long time ago and quietly stepped off. They understood something structural that most financial advice completely ignores. The tax code is designed to tax income. The word income is doing all the work in that sentence. If you stop having income, if your wealth exists in a form the government doesn't classify as income, you stop being taxable. It really is that mechanical. So the obvious question, how do you eat? How do you pay the mortgage, fill the car, send the kids to school if you have no income? That answer, buy. The invisible tax shield. Here is the foundational rule, and it is simpler than you've been led to believe. A gain is not a taxable event until you sell. Read that again and feel the weight of it. Sarah buys a stock at $50. Over 15 years, it climbs, slowly, then quickly, then slowly again, until it's sitting at $3,000. On paper, she has made an extraordinary amount of money. In reality, according to the tax system, she has made exactly nothing because she hasn't sold. The gain exists, it's real, her net worth reflects it, but it is completely invisible to the system as long as she holds. This is the tax shield. Not a product, not a service, not something you pay a wealth manager to construct. It is a natural property of how appreciation works. You are not being taxed on what you own. You are only being taxed on what you convert. The assets that work best are the ones that grow without generating taxable income along the way. Real estate that appreciates without paying rent into your personal account. Index funds that reinvest dividends rather than distributing them. Stocks specifically structured to grow in value while producing zero taxable distributions year after year. In the working class mindset, the goal is to cash out, build it up, take the win, spend it. Cashing out feels like success, but in the wealthy mindset, cashing out is failure. It is the voluntary surrender of your compounding engine to the government. Every dollar you convert is a dollar that stops growing and starts shrinking. Now, the obvious objection: you can't eat stocks. You can't hand your landlord a certificate. So how does this actually work in practice? That is where the machine gets interesting. Join the circle. Before the part that makes bank executives uncomfortable, a quick pause. If this is landing differently than the usual financial content, if it feels less like a pep talk and more like someone finally explaining the actual rules, hit subscribe and give this a like. It costs you nothing, and it tells the algorithm that there are serious people in this corner of YouTube who want real strategy, not motivation dressed up in finance. We're building a community of smart starters here. People who want to play the game to win, not just survive the week. Now, the gear that feels like a cheat code. Step 2, borrow, the infinite cash loop. This is the part where the math stops making intuitive sense, and that is exactly why almost nobody uses it. You have a $5 million portfolio. It's sitting there, appreciating, completely invisible to the tax man. You need $200,000 to live on this year. The house, the food, the school fees. In the working class model, you sell $200,000 worth of stock, pay $40,000 in capital gains tax, and move on. That $40,000 is gone. It will never compound again. Now, watch what happens instead. You walk into a bank and borrow against your portfolio. This is called a securities-backed line of credit. The bank looks at your $5 million in assets and offers to loan you 50% of that value. You take $200,000. The interest rate is 3%, maybe 4%. You owe $8,000 in interest for the year, not $40,000, $8,000. But here's the part that makes people stop and stare at the ceiling. A loan is not income. The tax system has no category for it. The $200,000 that just landed in your account is completely invisible. Because you didn't earn it, you borrowed it. You pay zero tax on that cash. Meanwhile, your original $5 million portfolio is still sitting there, still compounding at 7 or 8%. Your net worth is growing faster than the cost of the loan. You're not spending your wealth, you're borrowing against it at 3% while it grows at 7%. The gap between those two numbers is pure, untaxed acceleration. Your principal never gets touched, never gets taxed, never stops compounding. A financial perpetual motion machine. Step 3, die. The ultimate escape. This is where it stops sounding like clever finance and starts sounding like a glitch in reality. Eventually, everyone checks out. And in the working class model, this is when the tax man finally settles the score. A final reckoning. At least that's how most people assume it works. It doesn't. There's a provision called step up in basis. When your heirs inherit your assets, the cost basis, the number used to calculate how much you gained, is reset, not carried forward, reset to whatever the asset is worth on the day you died. Sarah bought her shares at $50. They're worth $3,000 when she dies. Her heirs inherit them with a cost basis of $3,000. The system simply erases the entire history of appreciation, decades of growth. The money that built her family's security vanishes from the tax ledger as if it never existed. Her heirs sell the stock the next morning, they pay zero tax, and they use a small portion of that clean, tax-free money to retire the bank loan Sarah was living on, and they keep the rest. She spent her entire adult life living on borrowed money at 3% instead of surrendering 30% to the government every year. She kept her engine intact from the first dollar to the last, and the system literally rewards this behavior. It's been written into the code for over a century. The threshold. When this works for you. Right, the real question. Marcus, that's elegant, but I have $80,000 in a retirement account and a car payment. That's fair. The math of buy, borrow, die does not work at small scale.
Banks won't offer you this line of credit on a small portfolio. Most institutions won't look at you until you have somewhere between $500,000 and $1 million in liquid assets. But here's the number that matters. If you're 45 or 50 and you have $800,000 sitting in a taxable brokerage account, you are at the threshold. You can borrow against that portfolio to bridge the gap to retirement age without selling a single share. The difference between selling to fund your life and borrowing to fund your life is the difference between a portfolio that shrinks every year and one that compounds to $2 million before you need to touch the principal. But here's the critical catch. This does not work inside a 401k or an IRA. Those accounts trigger a tax event the moment you access the money. The strategy lives in taxable brokerage accounts specifically. Asset location, where your money lives, not just how much of it exists, is the variable that separates the two models. Conclusion: architect the engine. The system is not rigged against you specifically. It is just that most of us were handed one rule book when a second one existed the whole time. We were taught to trade time for money and then hand a third of that time to the government. That's the deal on the conveyor belt. It's not malicious, it's just the default. And defaults exist to be examined. Wealth is not linear. It moves in phase transitions. Hard work and discipline get you to $100,000. That's real and it matters. But architecture, the deliberate structure of where assets live, how gains are deferred, how liquidity is created without conversion, that is what gets you to $2.5 million. Different tool set entirely, different game. 3 things before you close this tab. First, audit your asset location. Are you building assets you can borrow against, or are you generating taxable income that keeps you on the conveyor belt? Second, stop tracking coffee prices, start tracking tax efficiency. The latte is not the problem, the structure is the problem. Third, drop a comment with your age and the words, "I am changing the rules." Tell me one concrete thing you're doing to move toward the wealthy model. I read them. Understanding the billionaire tax structure is step 1. But there are 3 specific levels of net worth where everything changes. If you want to know which level you're at, this video is next. Marcus, signing off.